Chipotle, a giant in the restaurant industry. But is this stock a buy right now or a problem for your portfolio? We're diving deep into Chipotle, from its growing market share to its solid balance sheet. Can Chipotle bounce back, or is its future as murky as its recent performance? Welcome to the Food Fund. If you own Chipotle, or you're thinking about it, you need to see this. We've peeled back the noise to look at what matters. Let's start with the hard truth. Chipotle's stock performance. Over the last year, you're looking at a minus 12% CAGR. Zoom out to 5 years, an amazing 15% CAGR. Long-term, the company is doing very well. Let's see why. Market share, a key factor for food and restaurant companies, is a strong catalyst for the company. The dashboard shows Chipotle is not the largest restaurant company, but it is growing very nicely. They have 1.39% of the market share among public food, beverage, and restaurant stocks. Not too bad, right? Over the last 5 years, Chipotle's market share has actually compounded at 9.45%. Let that sink in. They've gone from 1.04% in 2021 to 1.39% today. That is a steady march upwards, though the rate of growth has slowed recently. When we look at the fundamentals, the story stays good. First, gross margin, a robust 40%. This gives them a lot of room for error if margin compression hits. Revenue? It's grown at a 13% over the past 5 years, now at $11.58 billion. Again, revenue growth might have slowed, but $11.58 billion is huge. Cash flow also looks amazing. Operating cash flow? Improved at a 15% CAGR. CapEx? Worsened by a 10% CAGR. The result? Free cash flow has grown at a 17% CAGR over the last 5 years. This is great, though free cash flow is down just slightly from 2024. Their share buybacks, which decreased shares from 1.43 billion to 1.36 billion, look great. This is what I love to see from good companies. Next, return on invested capital. This tells us how efficiently they're using investor money. From 12.4% in 2021 to 19.3% most recently, management is doing a great job driving returns. For a company this established, that's a great sign. And their operational efficiency, measured by the cash conversion cycle, while it went from minus 4 days to minus 6 days, that minor improvement is super important. The company is getting a little more efficient every year. Finally, debt. Net debt to EBITDA has fallen from 2.3 in 2021 to 1.4 most recently. This means it would take Chipotle a little less than 1.5 years of earnings to pay down their debt. With growing earnings, this value will continue to drift even lower. Now, let's compare Chipotle's performance against the gold standard, the S&P 500. Investing $10,000 in Chipotle would have grown to $58,508 compared to $35,579 in the S&P 500. That's an annualized return of 20.4% for Chipotle versus 14.3% for the S&P 500. Chipotle also showed higher volatility and a larger maximum drawdown, with slightly worse risk-adjusted returns, Sharpe and Sortino ratios. So Chipotle outperforms the S&P 500 in total return, but its high volatility means that it is not a holding for the faint of heart. Chipotle, founded in 1993, is the leader in the fast casual restaurant space, boasting over 3,600 locations across the United States and expanding internationally. Despite this strong position, growth is clearly slowing. The good news, relatively speaking, is that the slowdown is industry-wide, meaning that this is not a Chipotle management problem. Still, as long as Chipotle can maintain margins and grow market share, they will be well positioned for explosive growth once the economy returns to strength. Based on my proprietary scoring system, I give Chipotle an 8 out of 10. Chipotle is within my fundamental buy range. Before I share my final thoughts, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Chipotle. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 40%. The 5-year revenue per share CAGR is 14%, and the 5-year free cash flow per share CAGR is 19%. Nice. A return on invested capital of 19% is great and improving. Next, the cash conversion cycle of -6 days is very good, and a net debt to EBITDA of 1.4 is strong. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 2.8, which means that Chipotle is overvalued compared with expected earnings growth. Chipotle is a strong company, super popular with consumers and investors alike, but growth is slowing.
Same-store sales came in lower than expected, down 4%. Analysts were projecting a fall of 2.9%. This is its second consecutive contraction and also the biggest since the second quarter of 2020. Chipotle, though, reporting a return to positive comparable sales and transactions in the month of June.
The restaurant can weather the coming economic slowdown, but it's clearly not immune. Patience in the short term will likely be rewarded long term. What do you think about Chipotle? Are you an owner? Are you buying the dip? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now and remember to put your money where your mouth is.